Hello, everybody. Welcome to Clef Investments. Please remember to subscribe to my channel if you like it. So today, let's continue to talk about how to spend your stock portfolio after you retire. Last time we said there are two methods. So this time, let's do some further analysis. The first method is to spend fixed amount. So basically, you start with a fixed amount that can satisfy your daily living. And then every year, you withdraw a little bit more to meet the inflation, for example, 3%. And you can start with a small proportion, for example, 2%. Assume inflation is 3%. And in order to withdraw the money, you first use the dividend. Remember to subtract the tax. And if dividend is not enough, you should use one of the three methods as we said last time. So first, you could sell some stocks to make some money. And second, you could borrow using stock-backed loan. And finally, you can borrow using the box spread. And then, because the box will generate interest, which is capital loss, you can sell some stocks, which generates the same amount of capital gain. So effectively, you are selling stocks with tax-free. And hopefully, as the stock grows, because it will grow more than 3% a year in average, eventually, dividend will grow also similar to the stock, which is around 7%. After some time, you will only need to use dividend to pay off your withdrawal. And you will also have extra dividend to reinvest. So now let's do some analysis. Let's compare the three methods. So you can clone this link and compare it yourself. Okay, this is a parameter I want to modify, and we can compare three methods: sell, borrow, and box. Let's start with a very safe proportion, 2%, and assume stock grows around 7% a year, and dividend is today's S&P 500 dividend yield, which is 1.46%. Let's first look at the sell. If you go to sell, look at the net liquidation value at the end of each year. So it'll grow because your withdrawal money is only 3%. It's only started with 2% and it grows 3% a year. The stock portfolio will continue to grow. Finally, I used almost 100 years. Finally, it grows into $1 billion. Start with $1 million. If you use borrow, it also grew, but grew at a different rate. And because you borrow money to meet the withdrawal amount, because that's more than dividend, you get higher and higher leverage. So this is not good. So as time goes on, leverage goes high until after some point, the stock grows high enough and the dividend of the stock can be higher than your withdrawal amount. So finally, you can reinvest your dividend and reduce your leverage. So eventually, it will be similar to the sell method. You also get about $1 billion. And what about the box? So in this very safe environment, it's also similar. They grow to about $1.1 billion. And look at the leverage. So the max leverage it gets is 4.9%. Compared to borrow, you get 9% of the leverage. So box is obviously safer. It's about half of the leverage. So 2% is very safe. Now let's stress it. Let's change this by 50%, change it to 3%. So now you withdraw 50% more than before. That's a big increase. So let's stress this method. So with sell, you start with $1 million and the withdrawal, because now you withdraw more, it grows much slower. So at the end, it becomes $400 million. Still okay. And annualized the growth rate is about 6.5% in the end. Because after some time, there's more dividend than your withdrawal amount. So you're good. Now let's look at borrow. So with borrow, the net liquidation value, remember last time it was 1.1 billion. This time it's 0.9 billion. So it's close. And look at the leverage. So this measures how much money you are borrowing. And at the max, you are borrowing 29% of your portfolio. That's kind of risky because it's possible for stock to drop more than 70%. So it's not very safe already. It grows a lot, grows to $900 million, but it's not very safe in the middle. Only after some time, after the dividend is more than the withdrawal amount, then you are safe. But if stock drops too much before that happens, that's not good. So now let's look at the box. So with the box, it grew to $860 million. It's very close to the $900 million of the borrow method. And look at the leverage. So for the leverage, it's only 13%, less than 13%. Compared to the borrow, the leverage is 29%. So it's less than half. So box get almost the same amount of gain compared to borrow, but with much less risk, less than half of the risk. So that shows the power of box. Okay, so this is the method to spend a fixed amount.